Have you been looking for ways to erase your day job taxes and you don't know where to start? Well, watch this video because I'm going to show you exactly how people are doing that right now in this market to seriously reduce their tax liability. All right, let's get started. So what am I referring to? What I'm referring to is how you can take an investment asset and use it to wipe out your day job taxes. You know, you go to work every day, you make this W-2 income, you go to your preparer and you say, what can I do to lower my taxes? Typically what they'll tell you is cut your salary. That's one way to lower your taxes, or make charitable contributions. Well, neither one of those is oftentimes very appealing to someone when it comes to, hey, I need more money in my life, not less. So what are my options? Well, one option for you is to take something that everyone's doing and turn it into a tax deduction machine. What I'm referring to here is real estate. Now, some of you may have already heard of this strategy before. If not, listen up, because I'm going to be breaking down for you how you can take investment real estate and use it to massively increase a tax deduction for yourself that you can take advantage of this year. So what am I referring to here? What I'm referring to is depreciation. Now, it's a very particular type of depreciation that we want to take advantage of, because standard depreciation, well, if you're a W-2 wage earner, it's not really going to help you. And what do I mean by standard depreciation? What I'm getting at is if you buy a piece of property, okay? So let's say I go out there and I purchase a rental house like this, and I buy this house for $500,000. Now, rental property is depreciated. Per the tax code, you have to depreciate the property over its useful life. And for real estate, the useful life of residential property, which is 4 units or less, is 27 and a half years. So this is how a lot of CPAs handle residential real estate for their clients. Now, hold on a minute before I go any further. If you're wondering at this point in the video, you're saying, well, I don't have investment real estate. Well, I get it, but this is something you ought to consider taking advantage of by going out there and acquiring the rental real estate to take advantage of the strategy I'm going to be sharing with you. Okay, so what does that mean? Well, what you do is you take the asset itself, the prop, the structure, not the land. So we break it up and we say, all right, this particular house right here is worth $400,000. So what I'm getting at to reach this $400,000 is that you have a land cost that you can't depreciate. So assuming in this property here, my land cost is going to be $100K. So that's how I arrived at the $400,000 value for the structure. So with standard straight line depreciation, what we're doing with an asset like this property right here is we just have this little scale. And, you know, 1, 2, 3, all the way up to 27.5 years. And we put the value of the property right up here at 400K. Here's your house. And then we just depreciate it over time. So we take 27 and a half and divide it by the $400,000, which equates to about $14,000 a year you're going to be able to write off as this house depreciates over time. That's straight line depreciation. Now, if you're a W-2 wage earner and you earn less than $150,000 a year, you can take advantage of this $14,000 and write it off against your W-2 income. So for example, right here, if I was a W-2 wage earner and I was generating $110,000 a year from my W-2 job, and I bought an investment piece of real estate, I could take $14,000 here in depreciation and offset it against my $110,000 in W-2 income. Now, this assumes that we don't have any other income from our property and taxes and all that stuff. I just want you to get the concept of how depreciation works. Now, for many people, we have two problems with this. Okay, the first problem is we don't have excess depreciation that we can use to offset our rental income until we have multiple properties. And that is because our property itself has generated income. Maybe this rental property here generates for me $25,000 a year in income. Well, I'm going to take that income and use this depreciation down here to deduct it against my income. So rather than showing $25,000 in income, I'm instead going to show $11,000. So that means I have no depreciation losses to use on this side, so they're really no benefit to me. Well, what has changed and what makes this such a benefit for us is that with the new tax law that was passed this year, the big beautiful bill, you probably heard about it, One of the things that they did is they went back in and they reenacted or reinstituted the bonus depreciation on accelerated depreciation. So if you're not familiar with accelerated depreciation, let me draw it out for you. So with accelerated depreciation, what you are doing is you're using that same scale again. Let's say we have this asset right here, this house, and it's over 27 and a half years, 1, 2, 3, 4, 5, etc. With accelerated depreciation, we look at this asset and we say, hey, rather than take 27 and a half years to write it all off, we'll accelerate it and allow you to write it all off. And say this example, you were allowed to do it in year 1. So in year 1, you could deduct the entire amount of that asset. Okay, so with accelerated, they're pushing the time frame up and saying take more of it sooner. Now, how does this concept apply to real estate? Because this isn't realistic here. That doesn't apply 1 year writing off your house. The way it applies for real estate investors, which is really important to understand this concept now, is that the components of the property, this house, is comprised of more than just the framing. All right, it's comprised of foundations. It's comprised of sinks and wiring and fixtures and carpet and roof and landscaping and driveways and grass and lawns and all these little things that make your house your house. Now, under the Internal Revenue Code, you're allowed to take certain components of your property that make the entire property, and you can write off certain amounts at an earlier. Rather than the 27 and a half years, what they do is they put in a couple of different numbers here. They have a year 5, and, well, let me redo this. They have a year 5, they have year 7, and they have year 15. And so they look at your property and they say the components of that property are really comprised, or a good portion of it, of 5-year, 7-year, and 15-year property, meaning that there are certain aspects of this house that in year 5 will no longer have any useful life, that have always been used up. So what would that be? Maybe it's your refrigerator, maybe it's your carpet, okay, maybe it's your sinks, things like that. And so by year 5, all that has been used up, so you can depreciate it within 5 years. Okay. Now we go to 7-year. Now 7-year property is typically business stuff, so it's not going to apply on the residential side. Then you get up here to year 15, and what's going to be there? Shrubs, other landscaping, driveway, things like that. Some of the harder assets are there. So what we're doing now with your property is we're hiring someone to come in, look at your property, and they do it's really simple. What they do is they have you go around with your phone on a FaceTime, and you go through and you show them your entire house, the outside of the property, all the components to your house, your water heater, your furnace, your AC unit, and they take all that and they stick it into a program, and it punches it all up and says, all right, of this house right here, all right, this property, we have approximately $65,000 in 5-year assets. That means within 5 years, you're going to have to replace all that. It's going to cost you $65,000 to do it. Now, by year 15, we have an additional $35,000 in things that are going to need to be replaced. So they determine what that is. And so in my example right here with this property, generally speaking, if you have a property that you bought it for $500K, we take off the land value of $100,000, which leaves us with an asset value of $400,000, roughly 25% of that house will be categorized as either 5 or 15-year property. So that means it's eligible for this accelerated depreciation. So you don't have to wait 27 and a half years to use up the entire amount. They'll allow you, the IRS, okay, so we take this at 25%, that equals $100,000. You're going to be able to take that $100,000 a lot sooner. Now, here's where the tax code works for you as a W-2 wage earner. You see, this concept that I just described to you is accelerated depreciation. And people have been doing this for years. All right, what they'll do is they'll say, all right, within 5 years, I can take that $65,000 of assets, right? So rather than going the 27 and a half year line right here, we take 65 and we write it off over this period right here within 5 years. So you just divide 5 into 65, And that's going to come out with a certain number, and then that's what you're going to be able to write off over that 5-year period. Now, the $35,000 that we have right here, well, that's going to be taken over this period right here. So you divide 15 into 35. And so you see you get different numbers that show up, which would take your 14,000 in my previous example, and we're going to grow that up to maybe, now it's $27,000 a year you're writing off. That's great, but it can get better. You see, under the new big beautiful bill, what you're allowed to do is take this accelerated depreciation that is performed through a cost segregation study. Like I said, you have somebody come out and do this, and you can bonus it in year 1. So rather than wait 5 and 15 years, you take those things, you compress them all down. So in year 1 that I perform this study, then I can write all of this off. Now, how does this help you as a W-2 wage earner being able to take your $100,000 against your $120,000 in W-2 income? Well, in order to do that, there are some rules now that you have to be aware of in order to benefit from this. Because if you don't do what I'm about to share with you, then you'll only be able to use of this amount right here. Well, in my example, it'd be $20,000 of that amount. And then the rest gets carried forward. But if you want to take advantage of this, then what you should do is take your property, all right, here's my property again, and you need to turn it into what is referred to as a short-term rental. Okay, this is often called the short-term rental loophole, and what we're doing is we're getting out of the passive activity loss rules, which cap us on how much of our depreciation we can deduct. You see, you can do a cost segregation study. You can take bonus depreciation. And depending on your income, if you make more than $150,000 a year in W-2 income, you can't use any of it. You can only use it against other passive income. If I make $100,000 or less, I can use $25,000 of that. But $75,000 is not being used. Why can't I use it? Because the activity of renting my property out on a long-term basis, okay, is considered to be passive, okay? So what we want to do is change that. Take what is passive and turn it into non-passive. And the way I'm able to do that is by, again, taking and looking at the Internal Revenue Code, which allows us to take a property and turn it into a short-term rental, which means as long as the average rental period, okay, is 7 days or less. Okay, that's the first thing. We have to make sure our average rental period is 7 days or less. So how do you determine that? Well, I start renting it out. Maybe I put it on Airbnb and I have someone rent it for 10 days. And then I have another rental for 4 days. And then maybe I have another rental for 12 days. And then one for 3, and one for 5, and one for 6, and then another one for 4. All you do is you add up all of these days that it was rented, and you divide it by the number of rental periods. So 1, 2, 3, 4, 5, 6, 7. All right, so you just divide that by 7, and as long as this number here, the addition, you adding all these up, is less than 49, which I think it's pretty close here, it came pretty close, then you'll hit this test, you'll meet this test, 7 days or less. Now, that's just the first test. The second requirement to get to where you can write off the full $100,000 against your W-2 income in this example is you have to do something. You have to meet what is referred to as a material participation test. Now, what does that mean? So the IRS, running out 7 days or less, that's easy, but they have to show, they want to see that you did something, right? You just can't sit back and let someone else do all the rental work for you. You got to be engaged with your property. So you have two ways of doing this. You have a property, you have to show that you spent 100 hours on that property and more than anyone else, okay? So what does that mean? So I have a property, I spent 100 hours on maybe getting it furnished, working on the property. Maybe when I do a turn, I went and did some painting. I'm working on renting it out, dealing with the tenants. Maybe you're not doing the work on the property itself. Okay, that's fine. You can still qualify. As long as you keep a log and you show you spent at least 100 hours and it's more than anyone else, then you've met the material participation test. Now, the more than anyone else is important. Let's say you have a property that you buy that you're very active with, and you've got a lot of turns. Where you can run into problems is where you bring in your house cleaning, right, after a turn. So these people come in to clean your property. Well, if they're working on average, every time you do a turn, 5 hours, okay? On your 21st turn, they will have surpassed you, okay, in hours. So what you do then is you have several of these people cleaning your house. So neither one of them will get beyond the 100 hours. Maybe I have 5 people that I bring in to clean my property on a turn. I just keep, dividing it up amongst them. So I'm the one that has spent the 100 hours, and each of these, maybe they get no more than 70 hours apiece throughout the rental period of the year. Maybe it's 6 months, maybe it's an entire year, it doesn't matter. As long as it's just for that year, then you qualify for this. Okay. Now the other test is you spend 500 hours, but if it's only one property, it really doesn't make sense. So what does this mean to you as a W-2 wage earner? So if I met this test right here, so here's my W-2 income, okay, of $120,000, and then I have that property where I spent the 100 hours, right, 7 days or less, then I can pick up that $100,000 in bonus depreciation and use it to offset my income, which brings me down to $20,000 of taxable income for the year. This is how people reduce their taxes who are W-2 wage earners. We've worked with professionals, medical doctors, just standard W-2 wage earners, and what we'll tell them is, listen, you need to get a rental property. Now, you have to buy a rental property this year to make this work for you. Buy an investment property, put it into service, get it rented, and then perform a cost segregation study on it, and then start maximizing on this tax deduction. And you're going to find that that type of savings right there, that's basically like putting $25,000 in cash back into your pocket. Many times, that is going to be half the down payment on the asset that you're acquiring. So you're using the IRS as your partner to go out and buy real estate when you understand this strategy. Now, something that comes up a lot with people, they say, hey, I get involved with this short-term rental and I decide I don't like it anymore. That's fine. You don't have to stay as a short-term rental. You can quit after a year. If you decide, hey, this isn't for me, fine, turn it into a long-term rental. It's just during that period where you're taking advantage of this, it has to meet that test for the entire year, the average rental period of 7 days or less. It's a phenomenal strategy. It'll put a lot of money back in your pocket if you're taking advantage of it. And if you want to learn more, go into the show notes. I have a link for a free strategy session where you can speak with one of our strategists here at Anderson, and we can walk you through this strategy and show you how you can put it into effect for yourself this year and make sure you're maximizing your tax deductions before it's too late. If you liked the video, be sure to hit the like button, and I wish you the very best with your investing.